So let's take a look at the following. Let's take a look at um, the future, right? And what we want to find out is whether or not we do have stock market growth in the future. What do we think is going to happen? What do you think is going to happen? What could potentially happen? So what we're going to do right now is I'm going to share with you this video, and it's a very interesting video. It's a very interesting video because it talks about my good friend over at
Not only was my next guest among the first to call the current bull market, this was back in October 2022 when no one else could see it, he has been among the first to suggest that this market is now in a melt-up phase. I want to bring in Yardeni Research President Ed Yardeni. Ed, you know, this video I referenced said that there have been 15 market melt-ups since 1947, but warns like there were years like 29, obviously, 1999, where melt-ups were followed by massive crashes. So how do you assess the risks that are out there?
Well, I think the massive crashes occurred because the melt-ups were followed by recessions. Speculative bubbles burst. Very often they can cause a recession or be part of the events that lead to a recession. The current cycle has been totally wacky. I mean, we haven't had a credit crunch. We haven't had a recession despite very tight monetary policy. We are seeing the stock market at all-time record high. Ever since the Fed started lowering rates, and I think they did a little bit too much too soon, but that's what they did. And since they did it on September 18th, since the day before that, the NASDAQ's up 5% in a little over a month. The S&P 500's up a little over 3% in just a little over a month. So it's certainly has the aspects of a melt up, but it doesn't have to be a crash. It could be a correction, and I think that's what it'll be because I don't see a recession.
So, okay, you have 5,800 year-end target, and I know more recently I heard you say you're really optimistic about 6,300 next year. Right. Let's use one of your recent charts, though. And valuation has to be something to mention here. Valuations are pretty high now. We can see where the Mag 7, or in this case, the Mag 8, have come down, still relatively high. But when you talk about the market and you do.
So what is his point here? His point is that we think that the market is going to, this is a key word that they're using more and more now. They're using the melt-up situation. What is the melt-up? It's going to go up in value. It's going to go melt. It's going to go up. It's going to melt. It's going to melt and further up. And it looks to me that way because when we look at P ratio, what are we finding? We are finding that it is higher than it's up around 21 versus 19. So the P ratio is going up, and that's a good thing, but maybe we are asking too much for this market.
You do mention obviously a potential pullback here and there. How much more does that become a reality or a possibility, considering that these are PE ratios that historically have been associated with pullbacks?
Well, look, I could be contributing to the contrary trade here. I am bullish, and like you said, everybody else has turned bullish, and that's kind of bringing on my contrary instincts. But at the same time, since the beginning of the decade, we've been predicting this could turn out to be like the roaring 2020s, and so far so good. You know, we're almost halfway through the decade, and it certainly feels like the roaring 2020s in the stock market. And I think the surprise is going to be productivity.
We're looking at very high growth. He's looking, and he's usually right. He did say there was no recession when everybody was talking about a recession, and we don't have a recession.
Led growth. I think we're going to see better growth. And I think that's what the valuation multiples are discounting. That's where the high valuations are.
You wrote earlier in the week about bond vigilantes. You said they've already started voting. What exactly does that mean? Well,
the bond yield, and we anticipated this when the Fed cut the Fed funds rate by 50 basis points. We thought it was too much too soon, and we thought that they did that just in front of a bunch of stronger economic data, which is exactly what's happened. And as a result of that, we've gone from 3.65%, basically when the Fed started cutting the short-term rate, to 4.25%. Right. So the bond vigilantes are demonstrating that they're not particularly happy with the Fed. They think the Fed got ahead of things.
I got you. Hey, before I let you go, though, assess risk, right? Well, you see.
And that's a big question because no one knows how to calculate risk.
All these polls when they ask fund managers, and for instance, geopolitical risk high up there now, political outcome and acceptance of the outcome. How much of that concerns you with this market?
Well, it does concern me because, we got to 5,800 a couple of weeks ago, and that's our target for year end, and we didn't raise it. It seems like all the other strategists did raise it. Look, I've been very bullish, but maybe not bullish enough. I got to.
Exactly. Imagine he's not bullish enough, so we should expect a lot. Having said that, let me show you this chart. This basically shows you the forward P ratio that implies a 21-point moving average. Okay. Looking at the historical relationship between the S&P 500 forward P and subsequent 3-year returns in the benchmark shows that the current forward P ratio at almost 22 implies a 3% annualized return over the coming 3 years. 3% annualized returns, right? Look, when the P ratios are that high, going forward, you may not expect such a good amount of growth. And this is something that you need to be aware of. The data is not supporting continued growth forever. It's the same way we're not proponing a huge amount of increase going forward. So be aware of this valuation situation in the stock market.